Dive deep into unlocking your IRA and utilizing it to capture some big tax savings, but also utilizing it to capture a lot of equity growth in your retirement account. So I'm joined here by Lon Welsh. Lon is the founder and CEO of Ironton Capital. How you doing, Lon?
I'm doing fantastic. Thank you.
Glad you're here. I'm Nick Elder. I'm the head of investor relations at Ironton Capital, and I'm joined here by Zach and Ian with Madison Trust. So many of our investors use retirement accounts. They're leaving old employers. Maybe they got laid off or they're switching jobs, and they want to roll that money into a self-directed IRA. So we're really excited to dive in here. It's such a great opportunity to capture a lot of that debt equity movement in some of those old accounts, and pivot into a self-directed IRA company with Madison Trust. So you can leverage that and ultimately invest with us. Cool. So that being said, before we get into it, quick note from our attorney. So everything you see here is confidential. Any documents we send to you, fund documents through Ironton Capital, those are confidential. So any investment in a fund does involve a degree of risk. So always make sure that you are talking through everything with your attorney, your CPA, and your financial advisor. What you're seeing here tonight, this is not an offering of investment opportunity. So please understand that. You'll also see a lot of forward-looking statements. You'll see words like project, expect, plan, should, estimate. Please know that, again, those are forward-looking statements. And again, all this is company sourced information. So as you're going through all this, it's always good to have your CPA and financial advisor. A lot of you make your decisions with those individuals. So as you take all this information and create a plan moving forward, please make sure to include all your decision making partners in the process. So that being said, Lon, since you're on and you're on this slide, I'm going to pivot over to you and have you introduce yourself and the investment team at Ironton Capital.
Fantastic. I apologize, guys. I've got not the world's greatest internet connection here, so I'm going to try to turn my camera on. But if I get laggy, let me know, and then I'll switch the camera off so I can just put all the bandwidth over to audio. So Ironton Capital team is Brent Geyer, our CEO, who's got about 25 years of acquisition and development experience within real estate, and he's been a property manager for a really long time. Richard Landry, who used to work at Goldman Sachs and used to work at a family office managing over $100 million of assets, and he did a lot of our quantitative analysis. And then my background is I was a strategy consultant for 8 years at Accenture and Deloitte. And then I've been in real estate full time for a little over 2 decades doing development and then also running a large real estate brokerage. So what I want to talk about today is your IRA account. So the typical situation that comes up for a lot of our investors is they either have a self-directed IRA, or in some cases, it's rare, they'll have a self-directed 401k that's in the stock market, but they'd like to be able to diversify. So what I did in my situation is I had made 7 real estate limited partner investments in one of my self-directed IRAs. So the challenge that I wanted to talk about was if you keep it just as a traditional IRA, there's no taxes during the depreciating, but when you pull the capital out during your retirement, it's all taxed as ordinary income, even though the vast majority of the returns, in my case, and also for many of you, are actually long-term capital gains. And that's not something that's very well publicized. If you do the math, it's really a gigantic hit on the after-tax, not the pre-tax, but on the after-tax income that you can actually get to spend once the project is finished up. So a question that you might ask is there anything that you could be doing to legally manage these taxes in a more efficient manner? And what I want to talk to you tonight is the strategy that I did with my IRA, and it worked out great, and I hope it'll work out for you guys as well. So I moved it from being in stocks and bonds to being in real estate limited partnerships, like our National Diversified Fund, for example. And then I met with a CPA that specializes in this. He did a fair market value assessment for all the investments that I made. And he will probably be able to say that the value of your investment is about 35 to 50% less than your basis. So what that means is that if the annual investment that you made was $100,000, he'll be able to take the basis from $100,000 to somewhere between $65,000 and $50,000. The rationale is that the tax code said if you have an asset that's not liquid, Like if you own Apple stock, you can decide tomorrow morning to sell it and you'll have the cash in your account 3 days later. But if you invest in our long-term investment fund, the money is stuck. There's no liquidity for 5 years. That's a feature that enables you to write down the value of the asset from the IRS fair market value rules. And then the other is, if it's a limited partnership, you don't have any decision rights about how to manage it or when to sell it. Unlike if you have Apple stock in your portfolio, you have all the decision rights of when to buy or sell that Apple stock. So that's the mechanism the CPA uses to go from, say, the $100,000 value to the $50,000 value. And then he'll write up the documentation that you would need for the IRS backing up that valuation opinion. And then what you do is you give that fair market value assessment to your IRA custodian. So it'd be someone like Madison. And then they've got an ability to take the tax basis of 100,000 and mark it down to whatever your CPA has told you that it's now worth. And then what you do is you convert it to a Roth IRA. So what will happen is the amount in your Roth will be taxable income as ordinary income when you do this conversion. So if you would have done it when it was $100,000 balance and tax rate 35%, your tax bill would be $35,000. If he's able to, let's make the math easy, take the basis from 100,000 to 50,000, then at your 35% tax rate, your tax bill would be about 17,500. And the great thing about a Roth IRA is that once you're in a Roth status, it grows tax-free for the rest of your life. And if you do the math, and we're going to do that together here in a couple slides, it's a profound increase in the amount of money on an after-tax basis that your family's going to have available to invest. So you'll want to talk to your CPA, or I can introduce you to the CPA who did all this for me, find out if it applies to your situation. Everybody that we've referred so far, they were able to make it work, but of course, everyone's a little bit different. I'm not here to give tax advice. I'm just sharing what I did and the great results that I had. Nick, any questions on that so far?
No questions. Nope.
So for my Madison guys, is it a pretty easy process for you guys to do that fair market value revaluation?
Yeah, it's very simple. Once like the CPA does that valuation update, then they would just provide us with an updated form, or the client has their client portal that they can update it in there and upload that statement in there. And then after that, if they want to do that Roth conversion, it's a real simple form they fill out, either PDF form or in the client portal, the Roth conversion form, and makes it nice and easy.
Beautiful. Thanks. I'm so glad to have you guys on this call with us tonight. This is going to be, we've got like all the chess pieces on the board, which is nice.
Yeah.
So I wanted to do just a model for you. I'm going to assume that your IRA is $100,000 and you're at Vanguard in a stock fund, and you're 45 years old today. You want to start taking money out when you're 60, and you're guessing that you'll need money until you're 80 years old, and that you want to have, you want to mostly use up most of your account by the time that you're 80. So we're going to take a look at converting it to a self-directed IRA and investing in NDF. And then the other scenario I want to explore is, the NDF is our long-term investment fund, National Diversified Fund. And the other scenario is where we do this fair market value study, convert to a Roth, pay the taxes one time. So it's what I just outlined. I want to compare and contrast this for you guys so you can kind of see how that works. Now, when you want to explore this in a little bit more depth, we'll have a little link at the end of the presentation where you can set up a time to talk to Nick or me, and we could pop in what your IRA balance is and some of your other unique variables just to you. So instead of you just using this generic example, we can customize it to some extent, not perfectly, but we can do a lot of customization for you to help you get a better grasp on what this means to your family. And it'll be pretty easy for us to do that. So this is the different assumptions that we'll start with for today, just because they apply to the majority of the investors that I've talked about so far. So the baseline result is you do nothing, and just keeping the money in the stock and bond market in and of itself is a really excellent option. So if you take a look at the starting balance when you're 45 years old, you've got 100 grand in there, and we're assuming that the stock market goes up and you're adding $10,000 in the first year. So at the end of the first year, you've got 110. And each incremental year, the gains are a little bit bigger because of compounding interest. You're earning a 10% return not only on the initial start balance of 100, but also of all the profits you've had every single year that you've reinvested in there. So what you're going to find is that by the time you get to be 60 years old, your $100,000 investment with a 10% return, which is pretty typical for the stock market, is going to grow to about $417,000. It's going to about quadruple. So even doing nothing is fantastic. And then I backstalled for you that you could probably take out about $48,000 a year. And I am not a CPA. I am not a financial planner. This is just a hypothetical example to kind of get your mind wrapped around it, but you'll want to consult with your advisors for your situation. So you can see when you're 60 years old that you're going to start with 417,000. You're going to earn about 41,000, which is that 10% appreciation. You're going to take $48,000 out. So you're going to end up with about 411,000 in that account. So the amount you're withdrawing is really close to the amount that you're earning each year. And if you take that $48,000 and say you're in a 35% tax bracket, the amount you get to actually spend after tax is about 31,000. So then you can see this just continues from age 60 to age 80, and you're going to take out 48,000 bucks a year. So that works out to just a little bit over $1 million. And you're going to spend 350,000 in tax, and you're going to have 655 to spend. Does that make sense to everybody?
Yeah, that makes sense.
That's our default.
Just to recap here, Lon. So in this traditional IRA model, basically the initial capital grows to just over $1 million, and you're paying about 350,000 in taxes. Your net take home's about 655,000, going just the traditional IRA route in this example.
Yep.
Is that right? Okay.
Yeah. So for many of you guys who've got a $100,000 balance, this is a relatively reasonable set of assumptions of what might happen for you, and it's very solid. So let's take a look at some other options. Let's imagine that we convert this to a self-directed IRA with Madison, and we take it out of the stock market and we put it into the National Diversified Fund. Our target is to make 17 to 20% per year versus the stock market traditionally has returned about 10%. Well, what does that mean for you? Well, if you look at the total cash delivered, you'll see it's going to be 3.8 million. You get to spend about 2.5 million of that, and the total tax bill is going to be about 1.4 million. So just to recap, if we go back a page to the stock market, you could spend 650. If you invest the long-term fund, it'll potentially be as much as 2.5 million. It could be even more than that. That's just based on our targeted return. So this is quite an improvement. Of course, if you're really interested in diversification, maybe what you do is keep half in the stock market, move half into real estate. That's also a really good choice. So the main thing to highlight on this page is, like, not only does it generate a lot more profit for your family after tax, you're paying $1.4 million in tax, which is quite a lot. What can we do to manage that? So here's scenario 2. What we're going to do is sell the S&P 500 index, move it over to Madison, make a self-directed IRA, and then we're going to invest it in the stock market. And then what we'll do is we're going to have to pay $23,000. So where that comes from is assuming that when you get your $100,000 moved over, you have the CPA do the financial analysis, and he marks down the fair market value. You convert it to a Roth, and you have to pay the taxes right now. That's going to be $23,000 in this example. And what you're left with is about $94,000. So you've got 100 grand to start, 17,000 of gains. You pay the taxes one time, and there's 94,000 left to invest, and that's going to grow from then on out. So if you solve for this one, it works out to, you can take out about $150,000 a year, and it's all going to be tax-free because it's a Roth. So if you compare this to the prior page, without doing the fair market value, you and your family could take out $2.5 million. If you do the fair market value, you can take out $3.1 million. So it's about $600,000 more, and it's basically just all coming from not paying as much in taxes legally. Does that make sense?
That makes sense. wanted to recap on this one just one more time. So you're taking your $100,000, you're investing it in NDF10 through a traditional self-directed IRA. And then you're taking it to the CPA to do a fair market valuation. And they're going to look at this and they're going to assess the investment and say that because it's passive and because you have no control and because it's illiquid, you can't access that money, then we can reduce the basis of that $100,000 by about 35 to 50%.
Yes.
So now you do the rollover to the Roth IRA, which I'm guessing is more of like an on-paper rollover, right, Zach?
Yep.
There's a tax code. There's a whole outline of this in the tax code that describes it. So now your 100,000 is, let's call it 50,000. So now you're paying the taxes on your 50,000, and then from there on out, your $100,000 original investment is growing compounded over the next, in this case, 35 years from 100K to 3.15 million tax-free.
That's it. You've got
Okay.
it. That's it in a nutshell. So it's a very simple set of steps, and I think the CPA charges $3,000 or $4,000 to do the valuation. It takes them a couple weeks, so it's not a very difficult process, which is just wonderful. So here's just a recap. The estimated taxes paid under these couple different strategies, and then more importantly, let's look on the right at the estimated after tax that you get to spend, and you can see that it grows. This is the annual. It grows quite a bit by doing this strategy. So something that you'll want to keep in mind with your CPA as you're talking about the strategy is something called UBIT, unrelated business income tax. So it's a small tax that you'll have to pay within your IRA when there's some profits that are generated from real estate. So when you get a distribution in your IRA, you'll want to reinvest it, but you'll want to set aside a little bit that you can use to pay this tax. And your CPA will help you calculate it. It's usually not very large. And then whatever's left over after you pay the tax, just reinvest that part. So it's a pretty small amount. I'm not a tax professional, so I can't calculate this for you. The main message I want you to keep in mind is just keep talking to your CPA about the UBIT tax so that you guys collectively can manage it appropriately.
Real quick question on that, Lon. To my understanding, correct me if I'm wrong, so UBIT is primarily triggered when you're investing something that has a debt and equity component.
Yes,
but we'll have
that's
investors. Right. Okay, but we'll have investors that go into, for example, our income fund with their Roth IRA or a traditional IRA. That is strictly a debt instrument, so there's no UBIT that will trigger on an investment like that. Is that correct?
My understanding is with our income funds, there would be no UBIT tax. And again, I'm not a CPA, so you'll want to double check this. It should be something that will apply to our long-term growth funds.
Yeah.
So depending on what you're trying to accomplish in your IRA, it may not even be a factor for you. But I'd feel terrible if I didn't bring it up so that you could at least talk about it.
Lon, you still there?
I apologize for my internet. Yep, here. Can you hear me?
Yep.
So one other item that you'll want to keep in mind, it doesn't matter if this is in a stock fund or whatever you invest in, is that I believe once you turn 72 years old, you'll need to have what's called an RMD, or required minimum distribution from your IRA each year. And if you don't take the RMD, there's going to be some sort of a financial penalty for doing so. So once again, this is something that you'll want to keep in mind if you've got an IRA and that you're just processing it correctly with your CPA, and they'll give you the advice of how to manage around this here. I won't go into the details as I'll just create more questions that I'll be capable of answering as a non-CPA. You might ask, what does this fair market value study look like? So what I did here is I gave you a copy of mine, and you can see the fair market value is the price a willing non-related person to you would be willing to pay, and what you could be reasonably expected to accept as a seller if you had to sell this illiquid, no managerial control asset. In my case, it was a $100,000 initial investment, and the fair market value was $50,000. It may be a little bit different from 50. So he suggested I set your expectations at 65%, not 50%. It'll depend a little bit on your unique situation, probably. So the letter that you'll get from the CPA will look a lot like this. And this is the letter that you give to Madison, your custodian, and then they will adjust the taxable basis of your account based on the CPA's analysis. And you can see the factors are the discount for lack of control and the discount for the lack of marketability, which we talked about a little bit earlier. So that's in the presentation if you want to study that in a little bit more detail. So if you have any questions for me, I'm happy to address those. Otherwise, I'm going to turn it over to our team at Madison to talk to you about what is a self-directed IRA and how does that work?
No questions yet. I did want to just interject real quickly for those. We've been saying that a CPA will complete your fair market valuation. Please keep in mind, not every CPA does offer that. So we do work with a CPA. We've referred a CPA to a lot of our investors who have accomplished this strategy. So if you need a referral, feel free to reach out to us and we can give you the right contact. That being said, I'll turn it over to you guys.
All right, perfect. Well said on those other slides. I think that's a great strategy, and we're also not advisors over here, but it sounds very intriguing for what you did for yourself. But yeah, so love to dive into this now. What is a self-directed IRA and the topic of it and how it works and how the process looks, especially with Ironton Capital, because we have a specific process laid out with them. So first, want to just touch on what's the difference between a regular IRA or a 401k and a self-directed IRA. The main difference is we're just like a custodian, just like Charles Schwab or Fidelity, but we're not a fiduciary, and we handle the other types of investments that are not publicly traded. These are the private investments out there, like real estate, like these private placement deals that Ironton Capital is doing, other types of real estate or other types of investments that's very popular, lending money through promissory notes, doing precious metals. And then there's also people that love cryptocurrency, obviously. And that's something that you could all do within a self-directed IRA. And the main benefit is that you can utilize your retirement funds and leverage that tax advantage account that you have to make these investments. And that is really the true benefit. That Roth strategy that Lon was talking about that he did is really one of the best strategies that I personally seen, because you can pretty much utilize that Roth conversion to pay a small amount of taxes up front and then come out later with a Roth account and a very nice chunk of change there in your IRA. And yeah, with Madison Trust Company, we really service 4 types of IRA accounts. So we do have traditional Roth, and then some people send over like a SEP IRA or a simple IRA. Those are a little more for like self-employed individuals, and certain companies offer those plans. But yeah, those are the types of IRAs, and there's so many different assets out there, and the ones listed here are just a few. I mean, if you ever are creative, let's say you make some money with Ironton Capital and you want to invest into something out there that is very intriguing, there's a bunch of people that do startup companies, tech companies. I've seen people do Broadway shows. They lend some money to a Broadway show, and they get some returns from that. But obviously, here in Madison, we are just a passive custodian, so we can't provide any advice on the investments you're making or the tax strategies that you do. So that's why, just like they were saying, always make sure you're consulting with your CPA or financial advisor before you make any decisions for yourself. And that way you can make sure that everything is in good order and there's no problems in your IRA account, because this is precious money. This is your nest egg. This is money you want to take care of and grow for the future. So yeah, with that being said, I'd love to turn it over to Ian on what the process looks like and how a person can go through the process to make an investment.
Yeah, absolutely. Thanks, Zach. So, yeah, my whole job here.
You go to the next slide, by the way. Sorry.
Here we go.
Sure. So my whole job here is to make sure that all of our clients are well educated on the process, know what to expect on the front end before they get in the doors and start going through the actual steps in front of them. And so any investors that are looking to make these investments with Ironton Capital, first, they'd be introduced to me. I'd then have an initial consultation just to make sure we're on the same page, that you understand what you're getting into, just from more of a general process, make sure that your funds, in fact, are able to come over. For example, a lot of 401k plans with current employers are still locked up while you're still employed there. There are instances where that's not the case based on your age or some less restrictive plans, but that's just part of the initial conversation, is to make sure, yes, you can do this, you're eligible, and then also that you understand what you're getting into. And so that once you understand that, and we have our conversation, it's as simple as going through a quick online application through our client portal to establish the self-directed IRA. We then will help you pool the funds, however much you're looking to move over from another retirement plan, whether that be an IRA or 401k, TSP, something else. We'll help you in moving those funds over. It doesn't have to be the entire amount. It could be a partial transfer, a partial rollover. And so we can assist you there. And then once the funds are in the self-directed IRA here with Madison Trust Company, it's just a matter of making sure that the documents with Ironton Capital are filled out correctly, and that you authorize us to release the funds to them for the investment. And it's really as simple as that. Then we're just maintaining the account and servicing the account, handling the annual IRS reporting that goes along with it, and any returns generated would flow back into the account with Madison Trust as well.
Perfect. Yeah. So yeah, we could go to the next slide here, and this is slide I really like because it outlines exactly what the difference is from like just the regular process into the process with Ironton Capital, and how we really provide the white glove service. And so does Ironton Capital. I mean, this company is very great to work with. One of the easiest companies we work with, and the process is always super smooth. So very glad that we are on this webinar again. But yeah, so the first thing I want to mention here is, since we have such a great relationship with Ironton Capital, we do offer a promo code when people sign up to invest with Ironton Capital. They get $100 off of the initial fees in their account. So that'll waive usually their setup fee and also the first investment fee that they're making, which is great. And just like Ian said, that's built into our online application that we set up. So you would utilize the link that either Ian or the people at Ironton Capital provide to you, and now will bring you to the online application with a built-in promo code. Then second, for the movement of money, as Ian was discussing, this is where we will assist you. Our transfers team can reach out after you specify how you're going to move the money on that account application. Our transfers team will reach out accordingly to your situation, and we'll let you know exactly how to do an IRA to IRA transfer, or how to move over 401k into an IRA and doing a rollover from there. And then the last part here, really, I think this is one of the best benefits doing this with Ironton Capital through this system, is because they take such good care and provide the white glove service to assist you in providing the correct titling that you need on your documents. Usually there's like a subscription agreement that you'll fill out for the investment that you're making that will outline all the deals, and that needs to be utilized with specific titling. When it comes from IRAs, it's never you making an investment personally. It's always your IRA making the investment on your behalf. So everything's titled, for example, like Madison Trust Company, FBO, for the benefit of your name and your account number. And Ironton Capital knows all the titling. They have it locked down over there. So they really assist you and help you fill that out. Then you will sign that document. I believe they might do it electronically, but whatever, I'm sure they'll do your preference if you want to do electronic or ink. And then they will send it over to us on your behalf, just to make it nice and easy on you. So you don't have to worry about sending everything over to us. They'll allow you to sign it. They'll take your signed document when you're ready and send it over to us to start processing in your account. And once that's done, pretty much the process is all wrapped up. We're able to fund the investment and send the wire out to, or the check out to, Ironton Capital's delivery instructions that they provide. And after that, then you can talk about doing that Roth strategy and speaking to the CPA like Lon was talking about.
So what makes Madison Trust different from, the other providers out there for self-directed IRAs? It's a question that we get all the time, and rightfully so. People should be asking a question like that. They shouldn't just unknowingly go with a provider. And so the big difference, as Zach was pointing out, Ironton Capital really has a high focus on customer service, and that too is one of our priorities here. So we're well aligned there, but it's really about being accessible for our clients. The reality is that our clients aren't going to reach out to us very much. I mean, after everything is set up and funded, like, there are certain questions that'll come up, like the Roth conversion piece of things, or adding additional funds for a new investment. But a lot of the work is on the front end. And so we take good care of our clients in making sure that they're being walked through those first steps, and that they understand what's happening, and it's done quickly in a timely fashion. And then, because we know that you're not going to reach out very often, quite frankly, we want to make sure that when you do reach out, that you have an answer right then and there, that you're taken care of right then and there. There's no reason, you don't talk to us for a year and then you reach out and you have to wait 3 weeks to get a response. That's the reality of a lot of providers out there, and we don't want that to be the case for you. So you give us a call and we answer right then and there. We'll take care of you. On top of that, we have straightforward fees. We're not charging you based on the value of your account. So as the value of your account increases over time, our fees are staying the same. Again, unlike other providers where it'll be a percentage-based fee for the IRA services that are being provided. That's a big differentiator. So the fees plus the customer service, and along with the customer service is the expertise that our team provides. So that's, we have the training. We're passive custodians, so we don't give any investment advice, but we understand the situation, what our clients are going through, what they're trying to accomplish. And so we're able to take care of our clients because of that. So those are all big things to keep in mind here. Also, this isn't something that we just started yesterday. We've got it says over 4 billion. We've got, I think, over 5 billion at this point.
Yeah, I was going to say, I think I didn't update this slide with our marketing team, but it actually is, I believe, around 5 billion now, not 4 billion. So yeah, quite a bit of jump in the last year.
Yeah,
Amazing.
definitely.
Yeah.
Yeah.
Quick
And
question.
those other stats, just quickly, those other stats on there are also, I believe, up to date still. The 95% retention rate. We want to take care of our clients and make them happy so they stay with us, as well as there's testimonies. Feel free to reach out on Google, look at other platforms that provide reviews and ratings, and check them out for yourself and see what you think of them. And then, yeah, we have clients in all 50 states, so it doesn't matter where you are, what time zone you're in. We'll be able to accommodate.
Quick question for you guys. What is the typical time frame between an investor opening up an account, initiating the roller of their funds from their previous account to you guys, and then to funding? So what is the timeline for that entire process?
Yeah, so that's a great question. I would say it varies just a little bit, but we say around 2 weeks to 2.5 weeks or less. And then it could be possibly more depending on the situations. For example, with 401k rollovers, most of the time, a lot of 401k plans, they don't like to send wires, and that's their policy. It's not really our policy to control that or anything like that. But a lot of 401k plans, they just like to send checks and snail mail. And there's nothing the client can say or we can say to stop them from doing that. So they might send a check and might get here in a week or a week and a half. And then that will obviously delay the process just a little bit, but it's usually never over a month, especially with our communication with Ironton Capital and the clients out here. We try to wrap things up in around 2 weeks.
Good to know. Awesome. Karina's got a question. Fees associated with management of IRA are not tax deductible, as I understand, right? Lon kind of answered that already. Karina, obviously we're not CPAs, so I don't know for sure the answer to that, but my hunch tells me that because you're already in a tax advantaged account, that you likely do not benefit from additional tax deductions on that account. So please confirm that with your CPA, but that is my best guess. Do you guys have anything else you want to go through? Oh, looks like you got your contact info here.
Yeah, that's the most
Yeah,
important one
so-
right there.
Yeah, so if you have any questions, obviously Ian will usually be the person to contact first to work with on any clarifying questions about your specific situation before setting up your account. So that's his information right there. And if you want to look or schedule a call with him on that Calendly link, you can type that into your search bar and get his Calendly going. And then once you're actually signed up, then I will be your point of contact to work directly with you and Ironton Capital to move through the process and get your investment funded.
Awesome.
Fantastic. So if you look at the yellow highlight at the top, you can go to irontoncapital.com/Madison Trust 100, and that's where you'll get that special link for the offer they talked about.
Lon, did you want to go through some of these testimonials real quick?
Yeah, just a couple quick things, from some of our clients we currently have is, sometimes it's very hard to figure out where to invest in this market environment, particularly with the volatility in the stock market. And there's a lot of questions about the real estate market is going. So I've spent a couple decades trying to analyze and understand the real estate market to make it a little bit easier for you guys. Shalom, he and I have worked together a lot, and I'm really excited that he and his family have invested with us, and I think they're very happy with not having to have the stress of trying to make some of these investment decisions on their own. And Jared is one of our clients who used to have quite a few rental properties with a couple of bad tenants. And rather than just fighting it out, he said, I'm just going to sell these off, invest with us. And now he's probably making slightly more money than he was before as an active investor. He doesn't have all the headaches anymore. So really grateful to get the chance to work with him on that. So just as a recap, the yellow highlight again is that Madison Trust's special offer. And then if you'd like to set up a time with Nick or I to kind of modify that spreadsheet a little bit to your situation, we'd be delighted to have that conversation with you. So just set an appointment, irontoncapital.com/review, and you can pick a time to get on our calendar.
Awesome. I'm also putting my contact information. Awesome. I think that was the last slide. We got 20 minutes left, guys. So if you have any questions, feel free to send them on over. We'll stay here for a couple more minutes to address those.
And of course, you're going to think of like 3 questions as soon as we hang up. So just send us an email or a text, and we'll pick a time with you tomorrow to get on the phone, or text and email with you to answer your questions. So we're always available. And I know Ian and Zach would be available on their side for their mechanical questions as well.
Yep. I'll add one thing, guys, we've worked with a lot of different self-directed IRA companies. We just naturally, we see a lot of our investors come over, they use certain ones, but a lot of our investors are also asking, who should I go with? I've got an account with, Merrill Lynch. I've got an account with Morgan Stanley, and I can't self-direct my investments with you guys or with anything else other than like a typical stock and bond public traded entity, right? So, it's just been so great working with you guys. You're usually our first ones that we recommend. And really it comes down to just providing that white glove service. So if we can match our white glove service with your white glove service, it just ends up being good for everybody all around. So appreciate all the work you guys do.
Thank you so much for making it easy for our clients.
Yeah, thank you guys. I really appreciate having a company like yours that really assists, because sometimes it is a headache sometimes if the company doesn't know what they're doing, or if the investors, the clients, don't know what they're doing, and they get confused on those titling things, then there's a little bit of hold up, and it definitely could take more than a month. But when things are streamlined and we know the knowledge, and the company Ironton Capital has the knowledge of these types of investments, it just makes it such a seamless process.
Yep.
And then you can invest and kind of forget about it for a while. You just come back, visit your account once in a while, talk to the individuals at Ironton, get some updates, and then you retire and you have a nice lump sum of money.
So we got a question from Karina. What is the fee structure with Madison?
Yeah, Ian, if you want to take that.
Yeah, absolutely. So it can definitely depend based on what exactly you're doing, but most of our clients are simply paying $110 per quarter. That's the primary fee here. There can be other fees based on different transactions. Usually people are paying $50 to set up their account and $50 for their first investment. Again, with this relationship that we have and this promotion going on, it's you're saving on the front end, so you don't have any of the front end costs. It's just $110 per quarter. And I'm happy to share our fee schedule with anybody looking for more information. I'm actually going to drop my my calendar in the chat just so people can just copy and paste that if they need to schedule some time as well.
And is that based at all on, does a client's assets under management change that fee structure at all, or is that just per account regardless of AUM?
Regardless of AUM, yeah, it's great.
Yeah.
I mean, and if you have more than one investment, it'll go up a little bit per quarter, but yeah, it's regardless of the value of the account and more based on the investments, the number of investments you have.
Okay.
Yeah, and when you really look at it, where on that model that you're showing, if you keep the money with Ironton Capital for a while and it does grow, for example, to that $3 million range, to be only paying $440 flat rate fee a year for that account, I mean, other custodians, you will be paying thousands and thousands of dollars for a $3 million valuation of an account.
Yeah. Yeah.
So yeah, I mean, when the investment really grows up there, the flat rate fee really plays into effect and saves you a lot of money.
That sounds fantastic. Well, Zach and Ian, thank you so much for joining us tonight.
Sweet. Appreciate you all being here. Have a great rest of your evening. We'll be in touch. Take care.
Would you like for us to do an investment review for free? Go to irontoncapital.com/review and choose your time, and we'll be able to deep dive with you on your personal view and goals and answer any of your individual questions. Sound good? We have a lot of projects in the works, so our time is limited, so please go ahead and secure your spot now. We can't wait to see how we can help you with your investment goals as our gift to you.